Hello and welcome back to Stock Market Weekly. I'm your host, Evan Medeiros. This is the show that breaks down the good, the bad, the ugly across financial markets and then game plans for the week ahead. Mostly just bad and ugly out there. It was really a bear sort of stampede across the board. Not the whole week. We actually started off, kind of bouncing a little bit Monday, Tuesday, and once Wednesday sort of came, we rolled over sharply. There's a number of catalysts, some of which we've been talking about. We're going to break it all down here. Also quadruple witching, so ton of notional options contracts expiring. Let's get into it here. We've got plenty to cover. Our sponsor of this show is Investors Business Daily. We have two links in the description. Once you get done watching, grab yourself some discounts to their IBD Digital and their Market Surge platform. So our story this week starts with the Fed. The Fed convened and basically held interest rates steady. That was no surprise. The forecast, though, into the future, the Fed is now, getting tighter more hawkish in their stance, basically citing inflation concerns now with oil, consistently or staying elevated where it is. We now have that as a hurdle that the Fed has to deal with. And we are now pricing in, according to the Fed, an expectation that there would be one rate cut for the rest of the year. Now, of course, the second big elephant in the room here is this is another week with the war and the U.S. Over in Iran, things are still cloudy. There doesn't seem to be much of an exit plan. In fact, there's actually more tracking of potential troops to be deployed on the ground. That is obviously just total speculation at this point. But I think the bottom line is we're not really seeing sort of a exit date here. It's just continuing. Now, Treasuries, 10-year Treasury yield here is basically on a vertical ascent. Remember, we very briefly, just a few weeks ago, kind of poked below 4%, maybe get everybody excited that they could start to refi at lower rates on their mortgages. And suddenly now we are just screaming higher, of course, with the Fed out being more hawkish, with the war continuing. And basically, we're in this environment now where the inflation fears are just out in full force, higher for longer, and really stagflation is now what you're starting to hear everybody talk about. I'm not so sure I buy into that per se, but the market is clearly reacting here. Private credit is the third kind of issue for this market. This has been going on for some time. It's very opaque, right? Potential here. What started out as potentially maybe one-off sort of, individual sort of companies or banks or impaired balance sheets are now starting to just get more uncertain here. And so the financial conditions across all of these aspects are causing issues on the macro side. So this is the high yield corporate bond HYG ETF. So again, not a perfect proxy here, but this is basically just, again, looking at spreads between junk bonds or credit relative. What are the junk spreads based off of that? Credit, Treasury yields are higher. They're moving higher as well, but this here is not something you want to see continue to free fall, basically. You want to see stabilization. You want to see the ranges compress. You want to see volatility come down. And right now it's doing the exact opposite. All right. Gold hit hard this week. This was a big one. This is one of the biggest weeks here for gold on an unwind basis. So this is a 10-day rolling return chart of gold that I look through, and you can basically see that over the last 10 years, this is essentially one of the worst moves that we've seen in gold. You'd have to go back to COVID in 2020 when you had the brief sort of spike down there. This is the chart of GLD, big gap down here. This is the ETF, of course, and we are now below the lows from earlier this year, kind of testing them right at them right now. So this was obviously a super painful point in our Galahad portfolio because our all-weather has been oversized, overweight, long-term kind of big position here in GLD. So we naturally felt the pain. We did have insurance. I think our gold puts were up about 400% this week, but anytime you're bragging about your insurance going up that much, it means your underlying holdings really fell in lockstep. So we'll look at that portfolio a little bit later. And, throughout the sort of macro messiness, we also had Nvidia with their GTC event. I mean, basically it was more just blockbuster news in terms of the AI demand and the spending that's happening, the investment that's happening. I think Nvidia forecast over $1 trillion of revenue through 2027 for Blackwell and Vera Rubin, which are just huge numbers, and their gross margins are maintaining. You had Micron out with absolute killer numbers, and basically all of those stocks are just going down. So it's telling you, the market is sending a very clear message here that they don't care about this right now. This is not exciting enough. This is all great, but there are other concerns on the horizon, or things are priced in. And so as traders, we do need to keep that in mind as we move through and navigate these markets. So here is the weekly performance. GLD down 10%. Oil was green, up 1%, and everything else was down marginally here. The Qs 2% lower on the week. Here's the S&P 500. Again, you had that nice bounce to start the week, and then it was rollover central, and we are breaking support, and we are picking up steam to the downside. Now, of course, across all of that messiness we talked about, it was also, again, like I mentioned earlier, quadruple witching. So you have a lot of gamma sort of dynamics at play here, and you have a weekend, and you have, wartime sort of pressures. So there's just a nice cocktail of concern and anxiety that investors are naturally going to have going into the weekend. Here's the VIX. The VIX was, it performed this week, but it didn't really hedge you all that much. Going out 27.5, very elevated again, but didn't quite take out the 30 handle that it did last week briefly. Dollar index is kind of just sideways here, not really doing a tremendous amount, but 10-year treasuries are. We are up at almost 4.4% in a straight line. This is a problem, and if the market is to believe that the Fed may not get any cuts this year, right? What a difference in expectations on how we started the year, then this is what you're seeing. Sector performance on the week, XLE, financials were green as well, and that was encouraging to see. Now, financials have been really beaten up coming into this, so it was more so just kind of consolidating and taking a breather. Energy was really, the spot that was actually doing some performing. Everything else was negative. If we take a look at our smart trend filter indicator, this is a way to measure trend strength, path of least resistance. There's one sort of cheese that stands alone here. It's XLE. It's the only thing that we have a constructive mark on right now from a sector perspective. Tech is still bearish, but bearish to neutral. And utilities, kind of the opposite, bullish to neutral. Everything else is in a downtrend. So breadth here is getting worse under the hood. We can see this also with 52-week highs and lows. This data is as of Thursday, so I would expect a new high here made in the number of stocks hitting 52-week lows on Friday. But this ratio, it's something we talked about last week. You don't want to see the spike here, and we're getting the spike in the number of stocks hitting 52-week lows. Now, I threw this in here as well because I figured I'd forget about it later if I didn't. This is the percentage of stocks hitting 1 month lows. So this is a lot more of a short-term measure of capitulation. And you can see that these orange lines I have, so let me walk you through it. This is the Russell 2000 up top, Nasdaq 100 in the middle, S&P 500 on the bottom. This orange line is kind of where I would say washout levels kind of occur for each of these markets, right around 55 or so percent. And you can see that we're not there on any of them. We're getting closer. It is expanding. We are on the rise here, but we're not seeing a real washout event yet. It's been orderly, but I think after the action on Friday and this potential reaction on Monday, which is what we're going to talk about in the second half of this video, I think that's where you need to be on watch for capitulation and some type of spike and real washout here in some of these readings. This is the cues. This is the cues on a drawdown chart looking back 5 years. And you can see that the QQQ, in terms of an actual absolute number drawdown, it's 9% off of its highs. And if you look over the past 5 years, you can see that there are plenty of occasions where we draw down a lot worse than this, right? And so what I would say is, the drawdown is relatively minor and I mean, you could not even call it, I guess, a correction at this point, because I think a correction most people would say is 10%. So we're not even at a corrective state. We're still in a mild sort of pullback state. So, keep this into perspective that the damage here has been mostly done through time. And that's another thing we're going to spend a lot of time talking about on the second half of this video. Percentage of stocks above a 20 SMA. You can see you are hitting more of a washout reading here below the standard two standard deviation band. Put to call ratio, I would expect this is up here. Again, this is data as of Thursday at the time of recording this, so we're missing Friday's number, but I'm sure there was a reach for protection here into the weekend. Now, one bright spot you could say, though, is Bitcoin. It was down this week, but it's not making new lows like the Qs are, or the SPY is, or financials are. It's hanging in there. And so there's something to be said for that. This was a theme we talked about last week. Again, Bitcoin started this real rollover process, you could argue. It was the first to kind of break down and stay heavy. So in some aspects, this is really kind of the early indication of things. And so it's hanging in there around 70K right now. So let's keep an eye on it. There's also the Clarity Act that is got a little more kind of a push here on the end of this week. I think we have Congress in session for the next couple of weeks. So maybe we get a bill passed here, and maybe this is some of what Bitcoin is sniffing out. That would be a nice kind of shot of adrenaline, I think, to crypto, just generally speaking, but still TBD, right? If that can actually get through. Upcoming econ events next week, we have consumer sentiment. We've got some initial jobless claims, not a whole lot. So let's take a pause here and let's look at some charts in just a second. All right, we've got some charts in front of us. Warden TC2000 is the charting platform. S&P 500, this is a daily time frame we're looking at. Each bar just represents one day. Now, if you tuned into last week's episode, one of the things that we basically said would be expected would be a retest of the October and November lows, right? In the S&P 500, we sort of expected, based on last Friday's close, that it wouldn't be too surprising to see us kind of retest this area. So to a large degree, I mean, this action, kind of expected this week. Maybe not as sharp on Friday. We did get a very large range day. We got heavy volume, and we clearly undercut this prior support. So we didn't just kind of like meander down there in a very orderly way. We came slamming down there on Friday and we closed below it. So we do now officially have a new low and we have a new drawdown low. So from the highs made a couple months ago, we're now at roughly a 7.5%, 8% correction in the S&P 500. So as it stands now, we have broken support. We're testing, kind of breaking support right here. We're at about an 8% correction. And we know that just general market kind of history says that in any given year, you got to expect a 10% correction on any given year. You don't need a major catalyst. You really just need to shake kind of the tree to get complacent longs out of their positions, and you can get a 10% correction without some extreme catalyst. There's plenty of extreme catalysts right now. We talked about a lot of the bearish events happening, unfolding in real time. So this all sort of checks out. It feels ordinary. What I am waiting for now, or what I'm going to be paying attention to, is the capitulation, a capitulation type event. It could come Monday, or at least the start of it on Monday, where if we did get a Sunday night futures ugly open and then Monday morning we come into a 2% gap down in the indexes or something like that, you might now have the ingredients of at least a temporary sort of capitulation, not calling for any type of that's the low and we're totally done and the coast is clear. But if you're opportunistic and if you're playing that shorter term sort of horizon, watch for some capitulation early next week. That's what I will be paying attention to. I will start to, well, I do have my shopping list of names that I am waiting for, to get involved in, to start a position or to build a position. You really need to know if that's your cup of tea. If you're a swing trader, that doesn't want to deal with the headaches of a higher vol market and you're waiting for the coast to be clear, then you're just sitting on your hands. You're distancing yourself from the market and you're waiting for the market to start regaining support and some bigger levels and potentially start breaking out. So you do need to know kind of where you sit on that spectrum. That's unfortunately always the long spiel I need to go to when vol picks up because it is such an important concept. But as it stands right now, I am going to be watching for capitulation early next week. If we see continuation down, especially just vertically down, then I'll be looking at those 1 month lows to get to those washout levels. I'll look for other extreme readings and put to call ratio, breadth, those types of things. If we look at Bollinger Bands, for instance, a very classic sort of measurement here, you can see they're expanding downward and we're closing below on the 2 and 20 Bollinger Band. And if we just look generally at price structure here and we zoom out, I just want to anchor everyone's expectations. While we may want to be looking for some opportunistic short-term low, in the grand scheme of things, if we were to get a 10% correction, you're looking at levels down around 6,300. So call it, another 200 S&P 500 points below us. And if we were to get a 15% correction, well, then you're really looking at about 6,000, the round figure here, on a 15% correction in the S&P 500. That would approximately get you back to the old January 25 highs. Entirely reasonable for us to be in that kind of scope of things. Obviously, we likely wouldn't get there in a straight line. It would come with, impulses and retracements, but these are all the kind of the big picture, bear market pullback, retracements, whatever you want to call this. That's the things you need to hold into your head here of where you sit as a trader. How opportunistic are you trying to be? Do you have your shopping list ready? And, kind of what are you waiting for? So those are some of the things I'm watching for right here. I think a lot of the action right now just speaks to a lot of de-risking into the weekend for obvious reasons. The QQQ has broken support now, so clearly below 592. We made a new marginal low. Volume is picked up. And again, like we've talked about, vol compression leads to vol expansion. And now we are starting to get into that vol expansionary phase. If this proves to be some top here that we look back on and say, wow, that's a 5-6 month clear top here that was distribution, then again, you would be looking at much bigger retracement levels if we were to continue falling here. So I'm going to just remain open-minded that I have no idea which way and how far this market wants to fall, but I can understand the positioning in the short term. And there is a lot of fear out there. We know what the negative catalysts and headlines are. The fact that everybody's talking about inflation risk, stagflation, the war in Iran, the credit, concerns, the market has baked in a lot of negative, sort of news flow and talk. So you just have to remember where we are in that positioning cycle. And so the cues here, while there's definitely damage, I'm still trying to remain, kind of glass half full. While I have certainly taken down risk, it is something I still want to be kind of opportunistic on. And that's, currently the way I'm sort of framing this. So cues, ugly action, breakdown here, here's the weekly chart. So you can see kind of sliding down for, the fourth week in a row. But this is one that finally got some range to the downside. So eagerly kind of waiting to see how we follow this all up on Friday. I think the trickiest part here, to be, totally frank, is if we have this gap up and then we start this more grinding sideways like that. Tends to be the chop, the sideways is the, for traders tends to be the more difficult types of markets. Whereas if you just get you get that cascade, that liquidation spiral, it's clearer, that prices are just, you're repricing things in a fast way. You can see it. When you chop around forever, that's the more difficult sort of action. Along that point, which is what I wanted to bring up here, if we go back to Liberation Day and the correction that we saw with tariffs in 25, the QQQ had a 25% correction. Now, if you say to yourself, well, if we have that again, we've got a long ways to go. How could you even think about buying anything now? That would get you down to around 475. I think there's two ways that markets correct, right? And it's through price and through time. The liberation or this tariff correction here was a 25% correction that lasted 1.5 months. Now you could argue that the Qs have been digesting, right, pulling back since November of last year. So this current pullback, while is only a 9% correction, it's been going on for nearly 5 months. So while you may not get that same magnitude, you're kind of getting it in this choppy sideways, wearing people out of positions. And so it's what you fundamentally have to just think about in terms of corrections and how they can sort of manifest and create those opportunities that follow. So I think that's kind of everything I wanted to say on the majors, technical damage. If you should be taking stops, you should be taking your stops. Like, manage risk is absolutely front and foremost of importance. Let's take a look at GLD. This was a painful one for us this week, 10% down. You're not going to see that too often. Long-term trend, if you zoom out enough, still looks pretty innocent, but certainly in the short term, this is painful. Daily chart here, throw on Bollinger Bands, throw on any kind of oversold metric. You're at kind of bare bones, like total washout levels. Does not mean it has to stop going down, just simply displaying of the magnitude of this week's move in GLD, not performing any type of hedge whatsoever, but neither were the defensive areas of the market. Here's XLV was down 3% this week. Here's consumer staples down 4% this week. Utilities down 5% this week. So if you were trying to just stay in the safety areas of the market, that absolutely did not work. In fact, it was one of the worst places to be this week, was any of those more defensive, kind of spots. Energy. I mean, like we looked at on the sectors at the beginning, this is the only thing that properly hedged your portfolio. Even the VIX wasn't that great for you this week, just given the dynamics around volatility and the expiration. So IGV, I think, this week I posted a chart earlier on social. We're looking for that potential higher low. Haven't quite seen it yet, but notably IGV, it's not breaking new lows right here. It is still above the February lows. Looks a lot like Bitcoin. We talked about Bitcoin earlier, how it's hanging around 70K. These charts are trading in tandem, right now. They both bottomed approximately the same time, and they're both off the lows and are not cascading lower right now. Most of the selling was just, kind of front loaded is, kind of the big takeaway I would say there. Mags, have talked about how much I dislike this sector of the market. This continued lower. You're starting to now probably get to some areas where you're going to find value folks coming in on these particular stocks. You are at a roughly 16% correction here. If we look at tariff time, it was double that, 33%. But again, you're also taking your time on more of a sideways kind of top through time. So mags, they're definitely getting to be, on that oversold sort of area. And there's probably going to be some value in those stocks. Same ones I talked about last time. Nvidia, I like this one. I wouldn't pay for it here, but it got a lot cheaper this week, and so it's getting more interesting to me. This is one where it's kind of on that capitulation. Okay, if we finally get some capitulation in the market, how's Nvidia trading? What level is it trading at? This is something I would be looking at. You could throw Apple into that mix too. I still like both of those kind of Mag 7 names, and Tesla as well. This started to do some damage and spiral here on Friday, so paying attention to it, but I'm not taking a position in those stocks at this time. A couple of other standouts this week, I would say, and then we'll look at some Rockets trades. Space, Rocket Lab, I think is hanging in there pretty well. SpaceX, largely expected to IPO later this year. So maybe you're going to have some enthusiasm here in some of the space names. It's consolidating. It's got my attention. I don't have a trade on it yet. I don't have a signal, but it's gone very tight, and we know vol compression leads to expansion. So I'm just paying attention to it. Look at the volume coming in here. And PL was the big winner for us this week. This was a saving grace on Friday because our momentum holdings largely got washed out. Planet Labs is a name in our Rockets momentum model. It was up 25% on some news, I think, with partnership with Nvidia. So that helping some of the space. And ASTS, another one here. So space is pretty resilient right now. As speculative or as kind of growth heavy as that is, it's notably strong this week. And the other area I would say is notably strong, these are all ideas that I'm just watching, would be, I use WGMI as a proxy, but you could look at the Iron play or the Nebius play or the Wolf, all sort of the GPU data center sort of AI stack, all pretty, sturdy in a tape that is increasingly uncertain. So these are all just ideas and areas that I am paying attention to. Don't have much skin in the game at this point, but again, I am watching to see if there's some opportunity brewing, and I think that's it. Let's look at our trading systems, and then we'll call it a day. So here's our dashboard updated for Friday. S&P down 1.4, Galahad down 2, Rockets down 3.5. So Rockets sort of checks out. This is always going to be high beta, 2x probably on what the S&P is doing. Galahad, really tough week. One of the worst weeks it's had in probably a year or so, largely attributed to gold. Gold has been our largest position. It was down 10.5% this week. So Galahad felt it full stop. It was a painful 5-day performance here, and Galahad now has moved red on the year. So it's given up its early gains, still ahead of the S&P 500, still ahead of the Qs, but it's negative. So that's not fun. Rockets, let's take a look at some of these individual stocks here. So PL was our big winner on Friday, hit our first target, got close to our second target, so that saved our butts. Net, I'm going to just show this one again because it held up pretty well this week. This is my favorite pick out of the software space. I have a position here in Net, so I own this, and it's hanging in there. It's not so actionable right now where I say, hey, this is a great opportunity, but see if the dust can settle, see if it can get a retest of 205, maybe get a better entry on that one. Nebius, I actually just mentioned, so I think this one is interesting as well. We own it, and it held up there pretty well. It had some news and it had a secondary, so it was kind of all over the place this week, but generally speaking, held up well. And then one new one I'll give you this week, I don't think I mentioned it last week, was Carmen Holdings. So this one here, kind of in defense industrials play, it's right at our entry. It hasn't really done a whole lot. So we entered it back here on the 26th, and you can see it's just kind of chugging sideways here. But again, given the market environment and everything else that's ugly out there, this one's holding up pretty well. So, keep it on your watch list if you're interested. You can see our approximate stop right now is about $91. And that updates every day, of course, but those are at least a few names, well, a lot of names, frankly, a lot of those other stocks we looked through just a moment, and then here's some rocket stocks as well. And Yeah, it should be a fun week. It's going to be a busy one, I think, no matter how you cut it. So get some rest this weekend. And again, ask yourself, really dial in your strategy and if you really should be participating heavily in this type of environment or not. I think you just have to figure that out for yourself. There's no right or wrong answer for everyone, of course. So that is it for me. We've got links in the description of this show to our Galahad, our Rockets, our sponsor, IBD. Check those out this weekend, and I hope to see you back here next Friday. Take care, and thanks so much for tuning in.